Ind AS 109 financial instruments. The objective of an Ind AS 109 to establish principle for financial reporting of financial assets and financial liabilities that will present relevant and useful information to the user of financial statement for the assessment of amounts, timing, and uncertainty of an entity's future cash flow. So, financial instruments. The standard should be applied to all the entities and to all type of financial instrument except interest in subsidiaries. It should not be accepted interest in associate, interest in joint venture, other than those accounting for as per the standards accordance with the permission given by Ind AS 110, Ind AS 27, Ind AS 28. Right an obligation under the lease to which Ind AS 116 lease is applies. However, the lease receivables are subject to de-recognition and impairment requirement as per Ind AS 109. The lease liabilities are subject to de-recognition requirement as per Ind AS 109 and the derivatives are embedded in the lease are subject to the impairment derivative requirement as per Ind AS 9. Employees' rights and obligation under the Employees Benefit Plan to Ind AS 19, AS 19, employee benefit, they don't need to apply. Financial instrument issued by the entity that meet the definition of equity instrument, then they need not apply. Rights and obligation arises under the insurance contract, the contract in which scope of Ind AS 4 contains discretionary participation feature, then they need to apply. The forward contract to buy or sell or acquire that will end in business combination. The business combination, it is the financial instrument is done that need not to apply it. A loan commitment other than those with the entities designated as financial liability for a fair value through profit and loss, a loan committed that can be settled it in cash or delivering or issuing another financial instrument and commitment to provide the loan the below market interest rate, then they need not apply. And the financial instrument contracts an obligation under the share-based payment transaction, to which India is one or two share-based payment applies except the contract to buy sell non-financial asset which is within the scope of the standard. Then need not apply. The right to payment to reimburse the entities except so only I say not applying. So right to payment to reimburse the entity for expenditure that is required to be made in settlement and liability that is recognized as a provision in accordance with the AS 37, then the financial instrument doesn't apply. Right an obligation the scope of India's one AS 105 revenue from contract with customer that financial instrument except from those of India's 105 specific on the account of the accordance with the standards in 105 contract to buy or sell a non-financial item which cannot be settled in net cash or another financial instrument for exchanging financial instrument, then need not to this financial liability financial instrument doesn't apply. In the AS 109 first financial instruments recognition. Entity shall recognize a financial asset or financial liability in its balance sheet when and only when the entity becomes a party to the contractual provision and instrument. When they have a contractual provision of an instrument, then only they can consider the financial asset or financial liability. De-recognition of financial asset. When they to de-recognize it, the financial asset shall be de-recognized when and only when the contractual right to the cash flow from the financial asset expire. So there must be a contract, and that contract has a period. That period, within the period, they need to an asset. But when the expiry of the time period of the contract, then they de-recognize the financial asset. If transfer the financial asset or transfer qualifies for de-recognition. When sometimes the financial asset has been transferred, then such transfer should be qualifiable transfer. If that the case, then they can de-recognize a financial asset. On de-recognition of financial asset in its entirely, the difference between the carrying amount, the measured on the date of de-recognition, and the consideration received, including any new asset obtained or less a new liability assumed, shall be recognized in profit and loss account. When you de-recognize, some asset will be lying there in the books that either you have gained something out of the de-recognition. It is either a gain you need to charge to P&L. If there is a loss, you need to directly charge to P&L. In the case of partial derecognition of financial asset, the previous carrying amount of the whole asset shall be allocated between the part that continue to be recognized and the part that are derecognized on the basis of relative fair value of those parts on the date of transfer. Sometimes only a part of the asset has been derecognized. A part of the contract is only sold. Part of the transfer only expired, or the part is only transferred. Legal trust. Then, based on the recognition of like relative fair value of this part, that asset only can be charged to profit and loss account. Only that segment, not the whole. Derecognition of financial liability. The financial liability is a part of is or a part of financial liability shall be derecognized when and only it is extinguished. The obligation specified in the contract is discharge or cancel expires. So every obligation has three things. Another obligation to be discharged, or obligation has been expired, or the obligation can be cancelled. If in this three case only, they can be what be recognize the financial liability. Entities shall account for substantial modification in terms of contracts as an extinguishment of original financial liability and the recognition of new financial liability. Any difference between the carrying amount of financial liability extinguished or transferred and the consideration paid should be recognized in profit and loss account. Some liability may be um, when it is de-recognized, there may be a difference in the carrying amount and the financial liability. If the financial liability discharge is less than the actual fair value, you get a gain. If the financial liability is discharged with more than the amount you show in the book, it is a loss. So both profit and loss should be charged to P&L account. Classification of financial asset. The financial asset shall be classified and measured at a amortized cost, fair value, though other through other comprehensive income or fair value through profit and loss account based on both entities' business model for managing the financial asset and contractual cash flow characteristics of financial asset. So the financial asset can be considered through profit and loss account or through comprehensive income also, but only after considering the business model of the company and how is financial asset is positioned in the balance sheet or and we also see the contractual cash flow, so whether the cash flow accrues to operations or investments or finance. After seeing this only we can consider whether it's a comprehensive income or is a fair value through profit and loss account. The financial asset shall be measured at amortized cost if the both the following conditions are met. The business model objectives to hold financial asset in order to collect the contractual cash flow. The business model objective is to hold the financial asset in order to call the cash flow. Measured amortized cost if the both the following. So only so the financial asset will come again. The financial asset shall be measured at amortized cost if the both the following conditions are met. When they can be amortized cost. Condition 1. The business model objective is to hold the financial asset in order to collect the contractual cash flow. So you have an asset. The asset has been a financial asset. Only you believe so there is a future for it. And that future is viable. Then you keep it in the books of account. Then only you can charge on amortized cost. And the contractual term of the financial asset gives a rise on specific days to cash flow. That is solely payment of principal and interest on the principal amount outstanding. Second thing is that should be a contract. On that contract, it is within the period of the financial statement. That is, expiry period is not at met. Then the amount what they receive should be principal and interest basis and the interest should be based on the principal outstanding that not should be some overrated thing. It should be on the basis of a principal and interest. Example, I have financial asset. The court has said that the client need to pay amount of 1 crore rupees to the example. My client is, I will rephrase it. My client has gone to a hospital and he was mistreated, and he found out and he gone to civil suit. Now the court has said that you need to give amount of 1 crore to the patient, 1 crore, within a period of 1 year. We said 1 year you should give. Now what happens is you can have a financial asset of 1 crore in your books of account. Okay. And they have said on lapse of the 1 year, it will be charged to interest of 12 percentage per annum, simple interest or a compound interest. They should clarify the judgment. And it is said simple interest of 12% per annum to be paid if it is defaulted for every year. That they have every year the judge has given an order. Now the hospital has gone for appeal because they have 1 year period. But at the same time, they are not paying the amount. But now, what you can do, as per the original judgment, client can account as financial asset 1 crore plus interest receivable every day. That's 12% interest. If not paid after 1 year interest, so they can account after 1 year. So they can increase 1 year every day 1% or 12 percentage of the interest for every day, which you can accumulate it until the date of payment. So as per the judgment, this is was a basis. I'm saying the financial asset shall be measured at the fair value through other comprehensive income if both of the following conditions are met. So the financial asset can be only be measured in fair value when one of these two conditions are met because for comprehensive income. The business model objective to achieve by both collecting contractual cash flow and selling financial asset. So their objective is to sell the financial asset. Not only that, they have a contract. Not only that, they want to collect and contractual cash flow through it. Second thing is, contractual term of financial asset gives a right to specific dates to cash flow that is solely payment of principal and interest on the principal amount outstanding. So in this contract also they are saying about principal as plus interest, and the principal is the outstanding principal and the interest is on the outstanding principal. So if these both items, the asset is be contracting, asset is be sold for getting an for a contract, financial asset is being sold for getting a contractual cash flow. The contractual cash flow should be based on the principal and interest payment, interest basis. The interest should be based on the principal outstanding. These conditions to be definitely be satisfied. Both conditions should be satisfied to be considered as a financial instrument. The financial asset other than those measured in FTs, fair value, other fair value through other comprehensive income. Fair value through other comprehensive income. That is, an amortized record shall be measured at a fair value through profit and loss account. However, the entity may, at initial recognition, irrevocable designate a financial asset as measured at fair value through profit and loss account. If doing so eliminates and significantly reduces accounting mismatch. And it may also make an irrevocable election of initial recognition, particular investment in equity instrument that would otherwise be measured in fair value through profit and loss to present subsequent changes in a fair value and other comprehensive income. Sometimes the client may say, "Sir, I don't know what is the income I going to show." So they will say fair value through profit and loss account. They will make it. After that, when they receive, they will charge directly. If not, they know, they assuredly know what will be the fair value through other comprehensive income. What is the asset instrument, financial instrument? What will be the current price? If they know, then they can come to it. The classification of financial liability. Entity shall classify all the financial liabilities subsequent measured at the amortized cost except for financial liability at fair value through profit and loss account. They can't charge financial liability. They can't amortize the cost. They can't charge an amortized cost. Financial liability that arises when transfer of financial asset does not qualify for derecognition or when the continuing involvement approach. When a financial liabilities arise to the change of financial asset transfer, so that financial liability arise in that cases they can't consider value and amortized cost. Financial guarantee contract. In financial guarantee contract, there is no amortized cost. Commitment to provide loan at the below market interest rate. If that loan to be applied in below market interest rate, there is no amortized cost. Contingent consideration recognition of the acquirer in the business combination to which leads to Ind AS 103 applies. Acquires in a business combination in which on the applies. In that acquisition, in this case also, there is no amortized cost. The entity may, at the initial recognition, irrelevant designate a financial liability or measure the fair value through profit and loss account. So the financial liability to be considered in the P and profit and loss account, then initially recognized, then it can be when it financial liability is been settled based upon the settlement price to be booked as whether profit or loss. Embedded derivatives. Embedded derivative is a component of hybrid contract that is also included non-derivative host with an effect that some of the cash flow of the combined instrument vary in a way similar to standalone derivative. Hmm. Reclassification. When and only when the entity changes its business model for managing business asset, it shall reclassify the affected financial asset. So when the business changes its model, then it reclassify. So embedded derivatives are usually hybrid contracts that affect somehow the cash flow in combined instrument in a very way similar way as standalone derivatives. Derivative contract is totally different approach. So that risk arises through the contract of derivative purchase. So when two or more derivative are combined way, that brings out the different type of liability or different type of financial asset. So it should be it's a total different thing. We will speak later that about it. Measurement. Initial recognition entity shall measure the financial asset of financial liability or the fair value plus minus. In the case of financial asset or financial liability, not in fair value through profit and loss. Transaction cost that is directly attributable to the acquisition or issue of the financial asset or financial liability. And it should be measured at the financial in a fair value plus or minus the value in profit and loss account and minus the transaction cost are directly attributable to acquisition of the financial asset of liability. So, example, you're going to have a financial liability example. I'm going to get asset of 3 crores now. For getting that asset of 3 crores, I'm going to incur expense of 30 lakhs. Then the financial asset should be asset what I going to acquire minus the expense what you're going to incur. That should be recognition. An example as a financial liability. So settle the liability, I need to pay around 20,000 rupees. So the financial liability is liability plus 20,000. Such a way it should be recognized. The initial recognition, the entity shall measure the financial asset and financial liability in accordance with its classification. The entity shall recognize a loss allowance for expected credit loss on the financial asset that is measured in fair value through other comprehensive income, the amortized cost, and a lease receivable, loan commitment, and financial guarantee contract to which impairment requirement in the standard place. So, in the case of lease receivable, loan commitment, financial guarantee contract in which it should be measured in amortized cost. At the same time, loss also will be there, no? That should also be considered. The entity shall measure the expected credit loss, expected credit loss or financial instrument in a way that reflects unbiased and probably weighted amount that is determined by evaluating the range of possible outcome, the time value of money, and a reasonable and supportable information that is available without undue cost and effect of reporting date about the past events and the current condition and forecasting of future economic conditions. So whenever you revalue something a fair value, that should be measured as per the what is the expected loss that should be subtracted. And same time, it should not be biased. It should be always true and fair. And the amount what you're calculating should be probability plus weighted amount. What is the probability of what you're going to derive? As per the probability, and what is the amount? What is the you expected? Based upon the probability ratio, you should give the value. Outcome. The time value of money also to be considered. So, what is the present value of the money that you consider? A reasonable and supporting information is available without undue cost or effort that reporting did for the past events. Is like some other event happened? And what are the expenses as being income? What is the income that may occur? That is also to be considered. And current condition and forecasting of future economic condition. Sometimes you may see this case may get an additional income based upon your forecast, based upon your evidence. Because when they make competition, you need to consider that too. The gain or loss on the financial asset or financial liability that is measured at the fair value shall be recognized in profit and loss unless it is a part of hedging relationship or an investment in an entity in equity instrument for which the option to present gain and loss in other comprehensive income has been opted or a financial liability designated as at fair value through profit and loss. It is a financial asset measured in the fair value through other comprehensive income. So, of seeing this, the gain and loss of financial asset or financial liability. Financial asset, you get either a gain or loss, financial instrument. That is measured at a fair value. So, everything should be measured in fair value and shall be recognized in profit and loss unless it is a part of hedging relationship. So, in even you recognize the fair value, there may arise in profit and loss that you need to enter only when there is an hedging relationship or it's investment in an equity instrument for option to present gain and present loss in other comprehensive income. There should be in evidence. Example, you bought some derivative contract of what you option purchase of SBI shares in the futures of 2026. Today you made the purchase and you made it out today is the share will be this much they are offering in the market. You made that I need this much share in this day. Today is a favorable option. I'm going to buy. You bought the share. Now on 31st March 2025, the obligation what you said, mm, you gain something. Example, today is a share of the company is 600 rupees or 1500 600 rupees, but you are expecting the cost of the SBI in 2026 will be 900 rupees. And you bought it for 600 rupees, but 31st March, the price of the share is 900 rupees. So there is a gain of 300 rupees. You have not realized, but as the contract is there, you have a gain of 300 on this contract. So you need to show because the as segment reporting the present investment na, you're only going to pay only 600, but there is a gain of 300. So that is the comprehensive income. It is opted for financial liability designated fair value through profit and loss account and the financial asset measured fair value through comprehensive income. Hedge accounting. The objective of hedge accounting is to represent the financial statements, the effect of the entities, risk management activities that use financial instrument to manage exposure arising from particular risk that could affect the profit or loss or other comprehensive income. In the case of investment in equity instrument for which entity has elected to present change in the fair value of comprehensive income. Oh, you know what is hedging now? Hedging account is a present risk. So exposure will be there. Example, the same thing. You want to buy some shares, but you have one 10,000 rupees. but you believe so in 90 days, and the price of wheat will go from 30 to 35. You have 10,000 rupees. To buy a lot, you require 10,000 rupees. You bought this much lot of wheat in share market. You're hedging that. Right now, that creates an obligation to rather you have option, or the two things are there, futures and options. You have gone for an futures. That is going to buy it definitely. But if you go for options, you don't have an obligation to buy. So that's what it means it hedging accounting. Hedging instrument. The derivative measures a fair value through profit and loss may be designed as a hedging instrument. Hedging instrument always there is a fair value of measuring profit and loss. A non-derivative financial asset or a non-derivative financial liability measured the fair value through profit and loss may be designed as an hedging instrument unless it is a financial liability designed at the fair value through profit and loss for which amount of in charge is fair value that is attributable to change in the credit risk of the liability present in other comprehensive income. What they trying to say? The non-derivative financial asset or non-derivative financial liability measured at fair value through profit and loss may be designed as an hedging instrument unless the financial liability designate at the fair value through profit and loss in which amount of it is discharged in the fair value to attributable to charge in the credit risk of the liability in present and other comprehensive income. So you want to calculate income. When you can calculate income only when there is a fair value. When will be fair value both asset and liability, right? So in this case, the asset should be fair value. Then only on this date, when you're measuring the asset and liability, you can see whether the assets and liability on this date, what is the fair value. The difference between this can be charged to profit and loss account. This is what we said. Only a contract entered into by an entity with an party external to reporting entity can be designated as a hedge instrument. Hedging items. An hedge item can be recognized as asset or liability. An unrecognized firm commitment, a forecast in transaction, or a net investment in a foreign operation. Unrecognized foreign commitment or a forecast transactions can be also hedged item only. Now, hedge item can be a single item or a group of item, and hedge item can be reliable instruments. The hedge item can be a recognized asset and liability. Hedge item can be a non-recognized form commitment. Hedge income can be a forecast transaction. Hedge item can be a net investment in foreign operation also. Now, hedge item can be a single item or hedge item can be a group of item. Type of hedge relationship. There are three types of hedge relationship: fair value hedging, cash flow hedging, hedge and a net investment of foreign operation defined in the AS year 21. Fair value hedging. The hedge of the exposure to changes in fair value, recognized asset and liability, or unrecognized firm commitment. Exposure change in fair value of recognized asset and liability, exposure to change to unrecognized firm commitment, exposure change to change in fair value of component of such items, and exposure change in fair value that is attributable to particular risk and could affect profit and loss account. Hedge flow, cash flow hedge. Yeah, hedge is exposure to variability in cash flow that is attributable to particular risk are associated with or all a component what attributable to variability in cash flow that is attributable to a component of recognized asset and recognized liability or highly probable forecast transaction or it could affect the profit and loss account. Qualifying criteria for hedge accounting. The hedge relationship qualifies a hedge accounting only if all the following criteria are met. Hedge relationship consists of only of eligible hedging instrument and eligible hedge items. Only that mention eligible hedge and eligible items can be considered as hedge accounting. First point. Second, at the inception of the hedging relationship, there is a formal designation, there is a formal documentation of hedging relationship, and the entity's risk management objective and strategy for undertaking the hedge. There should be an agreement, there should be a relationship, there should be an entity risk of objective. Hedging relationship meet all the following hedge effectiveness requirement. That is economic relationship between hedged items and hedged instrument. There must be a relationship between the instrument and the hedged item. The effect of the credit risk does not dominate the value changes that result from the economic relationship. Okay. The hedge ratio of hedge relationship that is same as that relation resulting from quantified of hedge items. That is that the entity actually hedge and quantity of the hedging instrument that entity actually uses to hedge the quantity of hedging items. Hedge ratio of hedge relationship is the same as the relation resulting of quantity of hedge. So the hedging relationship should be same as the quantity of hedge item that is entity actually hedges and the quantity of hedging instruments that actually uses to hedge. So when they hedge for around 100 quantity in the in the agreement, same thing be in actual units. It can't be different. So that is what they're saying. I'm good for 100 barrel of crude oil, 100 barrel, 100 quintal of sugar, 100 quintal. That is the word. Said. In the case of hedging relationship, ceases to meet the hedging effectiveness requirement, resulting hedge ratio, but the risk management objective of the designated hedge relationship remains the same. The entity shall adjust the hedge ratio of the hedging relationship so that is meet the quantifying criteria called rebalancing. Rebalancing. Because when there is an difference in the hedge ratio of quantity and agreement should be same. If that it is not same, it seems to me it's not meet that criteria, but it has met with the obligation of the relationship of it. There is a financial risk in management. They need to balance it. Entity shall discontinue the hedging accounting prospectively only when the hedging relationship or a part of hedging relationship ceases to meet the qualifying criteria. Qualifying criteria, if they not feel they can be accounted for hedging accounting. After taking into account of any rebalancing of hedging relationship, if applicable. Ind AS 109 prescribed principle for hedge accounting and also requires a detailed disclosure. The disclosure explains both the effect of hedge accounting had been a financial statement and the entity's risk management strategy, as well as providing details about the derivatives that has been entered into and affect the entity's future cash flow. How is the cash flow is affected? That is also be said in the hedge accounting. Thank you.